at the monetary policy, portfolio investment, FDI, and FX targeting. This is all bullets put together. And this is another panel that has very highly qualified individuals being part of the team. But let me call to as the moderator for this event, Fumlele Mbio. Are you in the audience? Please put your hands together for him. Fumlele is the head macroeconomic research, Africa, at Standard Bank, and he will come up here at the podium and introduce his panelists. Then you will have 45 minutes.
Thank you very much, ladies and gentlemen. I will call, first of all, the lead speaker for this panel, Mr. Amin Amati, who is the IMF country chief. Please, if you can come to the podium, please. Mr. Mati has been with the IMF for quite a long time, since 2002. He has quite a lot of experience in the macroeconomy or in macroeconomic analysis, having worked in the Middle East, Central Asia, Europe, as well as the fiscal department of the IMF. He has been in Nigeria since 2017, and I was chatting to him earlier on, and he says that he has enjoyed his time here. Then I will call Mr. Peter Maila, who is from the CDC group. Mr. Maila has a wealth of experience in financial markets, having been in investment banking, private equity, telecoms for more than 15 years. I'm sure we will get plenty of insights from him during this panel. Mr. Ladell Robbins, principal at Africa Capital Alliance. Mr. Robbins joined ACA Group in 2013, August. He is responsible for FMCG as well as agribusiness investments there. I'm not sure if Dr. Yemi Kale is here. No, we don't have him. Anyway, I'll call Mr. Mati to make your opening remarks.
Thank you very much. And I have some pictures and slides, because I always found that slides say more than 10,000 words. So here, this is a topic that has many words: portfolio, FDI, monetary policy. How do we combine all that? So I thought it would be good to just give a bit of a background for the discussion on where we are. So on the recent developments, as you see in this graph, what happens is you had a big terms of trade shock, and you had a current account deficit that went to a current account surplus, and you have two different stories that happened. 2016-15, you have the big shock. You have trade, you have exports that have collapsed, but then we also had in 2016 and 17 imports that collapsed. So you have an import contraction because of several factors: exchange rate developments, some of the FX restrictions, etc., which led to a current account or trade surplus, a trade balance that was close to zero. And then in 2017 onwards until 2018, what we've seen is that oil price has gone up, and we are back to having a surplus where trade in goods and services is positive. And this is because oil exports have gone up. So we went to oil exports that were about $82 billion, or total exports were about $82 billion in 2015, that have come back somehow to about 45, 50 billion and going up to 60 billion now because of oil. We're still not back to where we were. That was where oil price was about 120 and oil production was a lot higher. But the recovery on oil export is there. Now, we've seen that on the financial accounts, and the financial accounts, you have the corresponding story there, where you have reserves that have picked up, and I'll come to that. You have portfolio flows that have picked up to finance this deficit, and these portfolio flows are mostly financial portfolio flows, and I'll come to that, and I'm sure our panelists will discuss some of that. Foreign direct investment through the period remained relatively flat, and I'll come to that. Here you see it clearly. Foreign direct investment was about 2% of GDP in 2011. Those are the long-term flows. Those are the ones necessary to sustain the economy. These have gone down. They're now at about 1% of GDP. The recovery hasn't yet picked up. The number there you see in 2018 H1, that's just the first half of the year. So, but we'll see where we are in the year. But those are the flows that haven't yet picked up. So which are the flows that did pick up? Here it is, portfolio flows. Portfolio flows in both foreign holdings of local debt. And when I talk about local debt, I'm talking about T-bills, government securities, and this is also happening in Nigeria, foreign holdings of CBN bills, the OMOs that are being issued. Now, the story is quite telling. If you look at fixed income, you've seen that you have about $2 billion in 2000 and let's say mid-2016. That has gone up to all the way to $16 billion. Those are all foreigners buying because yields were attractive, a lot higher than what it was in the emerging markets or other markets, with an exchange rate that turned out to be a little bit more stable. And that has continued until about April, May 2018, where you had some of the emerging market turmoil, and that started, foreign investors don't always distinguish what happens in different emerging markets. You have seen some retrenchment. You have also some domestic factors that could also play a role. But whatever happens in terms of foreign holdings, you have to always keep in mind it's domestic factors, but also external factors. So it's not just depending on Nigeria. This, as you know, Nigeria is not in an island. You also have global factors. And the same story is happening on the equity markets, except you've seen, less of a pickup. I mean, you've seen equity markets in 2014 about $12 billion, went down to about $4 billion, went back up, and then more recently decreased. And then the last month, if you were to look at the outflows, you would have seen also a decrease. Now, a caveat here. These are numbers that I've taken from the custodians. Total, you will find that at the end of August, we're at about $21 billion of foreign holdings. Some of these numbers, Stanbic have them. Some of these numbers are also higher by others, including CBN. So those are numbers that we're still looking at. But it's foreign holdings. But when I look at the drop, which is about $5 billion drop in foreign holdings since April, we also need to take into account that some of the equity shares have also lost. So the price is gone. So there's also some valuation effect that would be reflected here. Now, I talked about the interest of foreigners because of interesting yields. Well, that was particularly true in 2017. You had yields of about 18%, effectively about 22.5%. Then that was for 3-month yields. Then, the government engaged in a strategy of shifting domestic into external debt. There was less issuance. By the end of 2017, we started seeing a collapse of the yield curve. And you have, at the low end, yields as much as 11%. So you have basically 700 basis points drop, which, of course, one of the factors that I said will affect investors. Well, yields may not have turned out in the later part of 2018 as attractive as they used to be. Now, there's two different stories. That's one story is that 2017 it was expensive. There was a switch in the strategy. some of the yields have come down. Well, after the turmoil and in the latter part of 2018, over the last 3 or 4 months, we've seen a reversal. The yield curve has now shifted back up. And what we've seen, if you look at it here, is that in September 18, effectively, when you look at the 3-month, 6-month, 365 days, which is some of the instruments that have come back, we're back at the 15% range, effective yields. So those are the yields collected from Bloomberg. So what I'm saying is that yields do matter, and for foreign portfolio investors, obviously, looking at those returns is what would matter. Also, they would look at dollar returns, so therefore what is the performance of the exchange rate would also matter. And I just put this slide here just to emphasize the point that what happens in Nigeria's domestic markets in terms of yields, in terms of foreign behavior, investors' behavior, is not just a Nigeria specific. It also depends on how investors are seeing emerging markets in general. And we've seen some of the turmoil that started this summer in Turkey because of domestic factors, but also global factor. You also have global tightening. Argentina, some also domestic factors. And you've seen some of that. You see it in CDS spreads, which I showed. You'll see it in exchange rate movements. If I were to put equity markets, you would also see some of those big jumps. Now, I was talking about current account surplus. That's a positive factor for reserves, right? Then you have oil price that is up. There was a big recovery in oil price that contributed to the current account surplus. I just discussed the portfolio flows. That is also a positive. Current account surplus, portfolio flows, all of that contributing to the reserve buildup. So reserves were at a trough of about $24 billion in October 2016. Since then, Nigeria has come a long way. Went all the way to $47.8 billion earlier this year. So the reserve buildup is there. In terms of amount of imports, it's comfortable above 8. But given the outflow that has happened since April, and I would say that an outflow about $5 billion probably is in the market, but I know there's a lot of people in the room that work in the market and that can correct me and maybe give me the right figure. And that plus, the positive on the current account that continues, we're getting reserves that have taken some of the brunt. So we're no longer at 47.5. We have reserves that today are at 45 billion, 45.5, and I think today maybe slightly below 45. That's the picture that we have. So what are the policy implication and response? Well, obviously, one key factor when we look at the external environment will be the exchange rate. So what is happening in the exchange rate? Well, you asked me this question in 2016, I would have talked to you about 11 exchange rates. I can't keep track of all of that. Today, we really have 3 major exchange rates, and we have a convergence of the exchange rates towards a single rate. It's happening progressively, but you have the official rate that is at 305, mostly for the fuel products. But since April 2017, which is when a lot of foreign investors started coming in with the R&D window, you have the R&D rate that went from 400, 380, stabilized around 360 Naira per dollar. Then we had other windows, the retail, the wholesale. The wholesale only 2 months ago was at 340 Naira per dollar. Today it's about 357 Naira per dollar. So a convergence of the exchange rate has happened, so the central bank is progressively moving there, and a lot of the flows are happening at the R&D window. Now, how has all this happened, and how do you manage to keep an exchange rate that's also relatively stable? Well, a tight monetary policy has to play its role. And for that, one measure of looking at it is keeping broad money as tight as possible, negative. That's what it was in most of 2017. And actually, I'll come back to inflation in a bit, which also affects the exchange rate. You've seen really the 2 different paths, right? In 2014, 15, you had broad money that was really going up, but you also had inflation that kept going up. And banks were lending there. Credit to the private sector was up. Today, credit to private sector has been reduced, but that has contributed significantly to reducing inflation. And inflation went from 18.4% to about 11%. So here I come back to the theme of the presentation. You have different objectives, different policies. You have to choose. You cannot control all the different objectives you're trying to achieve. And, you know, to try to keep the exchange rate relatively stable, but also to keep inflation stable, which is the main objective of monetary policy, as stated earlier, then something may have to give. And in this case, credit to the private sector had to give. Now, what was monetary policy? And you see it here, and actually, we only see it from January 2018, so I apologize for not showing it to you for previously. So in 2017, would have been the opposite. You would find that a lot of the overnight rate, or what I would call the money market rate, is way above the policy rate. Is way below the policy rate. And then in 2017 was way above the policy rate, meaning that on average, the central bank was tightening. There was less excess liquidity, and the money market rate was much higher than the policy rate, signaling a tightening. That has been loosened a bit more recently, where we have a bit more excess liquidity in the system, and the money market rate is outside the interest corridor and outside but way below. And you see that in the black line there, that's way below the 14%, which is to be the rate that signals what the money market rate should be. So I'm going to be quick and talk about some of the remaining challenges. So I talked about a convergence that is happening on the exchange rate, and convergence is good. And one market is also good for investors when they have one rate. What is the rate? Some of the retailers also need to find out, are the competitions also being charged the same rate I am? And we've done a study on this where we looked at countries that have a unified exchange rate. And generally, countries that have a unified exchange rate have a lower inflation rate by about 2 percentage points, and have a higher growth rate. And the growth rate panel, I haven't shown it here, but you find it, and it's consistent with the emerging market and sub-Saharan Africa. Again, that higher growth, lower inflation, that's also good for some of the investors to come in. But that's one of the challenge. I talked about inflation earlier. I'll go very quick here. Inflation did pick up. It has gone down. And again, I come back to one of the slides I had earlier. A tight monetary policy did contribute to having inflation lower, which is also good for growth, as stated also by some of the speakers earlier, and also for investors coming for higher return. One of the challenge, of course, you have multiple objectives. You cannot meet all your objectives with the policies you have at hand. So growth is recovering, but growth is still remaining subdued as you control for inflation or the exchange rate. And that's why you had a growth that remained at 1.95 the first quarter of 2018, 1.5% year on year in the second quarter. And actually, if you were to decompose growth, let's take out oil, that's 10% of the economy. Let's take out agriculture, that is 26% of the economy. And you're left with non-oil, non-agricultural side. And that has been either flat or negative over the past year. And private sector credit was at minus 6% for the first 5 months of the year, barely at 0% year on year. So we've now also seen that banks have not been lending, even though there's some more excess liquidity in the system, because credit risk is also a factor. I'll come back to some of the doing business in a bit. So I talked about where we are and some of the developments in the economy, and hopefully you have also noted that you need to look at the trade-offs between the objective you're trying to do to have and some of the policies. So then, what to do? What are the recommendations? How do you maintain? What are the policies to pursue to make sure that you have long-term investment, not just hot money coming in, and that you have growth that is recurring? And by the way, higher growth will get you some of the investment. And that's my two different slides here. I would say keep monetary policy tight, and that could be by having a money market rate or even a policy rate higher, but you need to have the monetary policy framework or the signaling from the monetary policy that is respected. And that includes also maybe a wider interest rate corridor to avoid the situation that I talked about earlier when the money market rate was way below the interest rate corridor. Now, I talked about having a unified exchange rate and removing the multiple currency practices. And fiscal policy is important. Tight fiscal policy is also going to help in trying to reduce the vulnerability on the fiscal sector. That's also going to reassure some of the investors. Interest payment to revenue in Nigeria is about 50%, which means that half of your revenues are spent on paying interest, which reduces the amount of money that goes for infrastructure, which is needed. And some of the ways of doing that, we can come to that, would be non-oil revenue mobilization would be the number one. Then, of course, we have some bankers in the room. Credit risk is one issue I mentioned earlier. So therefore, as you try to lend, first of all, not only try to improve or reduce your NPLs, but also improve your capital buffers to be able to address some of the risks. So I think that will be one recommendation. Then last but not least, you're trying to grow the economy. You're trying to attract long-term investment, FDI. It's important that you engage in structural reforms. Power sector is the number one constraint to doing business that's being listed. Infrastructure is another constraint. Anti-corruption is another constraint. The regulatory environment in trying to simplification, that is all important. And I'll conclude with one last remark. You noted that I talked about policies, about exchange rate, etc. at the beginning, and the external factor. And I want to conclude to say, if you want to attract long-term investment, the panacea is not just one policy. It's a package of policies. So it's going to take exchange rate policy, monetary policy, fiscal policy, a strong banking sector, and structural reforms for those flows to come in on a sustainable manner and get growth on a higher path. Thank you.
Thank you very much, Mr. Marty, for that. I want to pick up on two things that you raised during your presentation. Firstly, I think the way that this topic was crafted, it sort of suggests that there is an inherent conflict between monetary policy management and exchange rate targeting or targeting an exchange rate and the goal of attracting foreign portfolio and direct investment inflows into an economy. Now, for many countries in Africa, and I would say that Nigeria included as well, it's not enough to mobilize domestic savings for investment purposes in order to power growth. You need to attract foreign investment as well. But you pointed to one thing that caught my eye, the contagion effect, especially in recent months when we saw sell-offs in Turkey, Argentina, and so on, affecting other markets, and seemingly Africa and Nigeria is going to be affected by this as well. Talk to us about, first of all, why there is such a conflict, if indeed there is a conflict between monetary policy management and foreign direct as well as portfolio flows into an economy.
Thank you. On the conflict, monetary policy, if you look at the many central banks, when they look at the different roles, you have usually inflation as the primary objective, but then other secondary objectives come in, exchange rate, development objective, exchange rate stability, development, and then, financial stability. So those other objectives are important, but the first one and primary objective should and remain inflation. And to try to reduce inflation, if you look at inflation threshold of about 12%, below that, for a country like Nigeria, we've seen that to try to spur growth, trying to go to single digit will be important. Now, monetary policy will have an impact on interest rates. Interest rates will have an impact on inflation, but interest rates will also have an impact on some of the inflows that come into the economy. That will also have an impact on what the exchange rate is going to be. And so all of that would impact the external balance, and therefore that's where some of the conflict comes in. In terms of FDI, it's not just a question of monetary policy, it's a question of what is the structural environment, what are the macro fundamentals, including the fiscal, the debt levels, all of that would come into play before you see some of that FDI coming in a more sustainable manner.
Okay. Mr. Robbins, information is very important, not only in terms of policy formulation, whether it be for monetary policy or structural economic policies that a country might develop, but also for businesses that are looking to invest in an economy. Can you talk to us about your experience and the experience of your business in terms of evaluating the opportunities and the threats and challenges that are present in the Nigerian economy?
Sure. So my name again is Liddell, and I work for a West Africa-based private equity firm. We typically invest in companies for a 5 to 7 year hold period. So in the process of trying to determine which opportunities to pursue, we try and gather information from almost any source, that we can. We speak to people in the business community. We speak to people in kind of the research community. We speak to individuals that are members of this association, trying to kind of get a sense for which way the wind is blowing currently and how it's likely to blow, over the life cycle of the investment, which is quite difficult to determine, as you can imagine. And then when we gather all of that information, we use that to basically kind of counterbalance or to essentially kind of create our views on the outlook for the business that we are evaluating. And where that kind of intersects with monetary policy, particularly given the period that we've come out of the last couple of years, is the majority of our investors are dollar-based investors. And for that reason, we are really trying to understand first the risk that exists to foreign exchange rates. Then secondly, what is the ability of this business to outperform, the expectations that we have for foreign exchange rates? And then what does that ultimately mean for our, total potential returns in dollars? So information is very important. The ability to kind of synthesize the information and develop a view is what ultimately helps us get comfortable with the prospects for an investment, because in general, we believe that the majority of the businesses that we come across have the potential to make money. It's whether or not the macro context, and then I'll say kind of the broader enabling environment, give us, a decent shot towards that business actually being able to perform and ultimately our investment being able to perform. I hope I've answered your question.
Specifically, if you look at, as you say, you look at other countries besides Nigeria as well, your experience of evaluating those opportunities in Nigeria relative to everywhere else, in terms of the information quality, the ease with which you can relate the information that you get with the general macro environment, as well as the opportunities that you're seeing in Nigeria.
how does Nigeria compare with the other countries on the continent that you invest in?
Okay, so we're a West Africa-focused private equity fund manager, and Nigeria is our major market. Ghana is another market that we're quite focused on, and then we have begun to explore Cote d'Ivoire. Overall, I would say if I kind of had to line, all of them up, I would say Ghana maybe is slightly better. And I think probably the reason why that is the case is that it's a smaller market and it is easier to kind of get in front of the people to gather the information that you want, to ascertain. I think what works in Nigeria's advantage is because of Nigeria's size, you have more people out there providing different views versus some of the other countries that we look at. So on balance, I would say access to information is easier here. Access to quality information is probably easier in Ghana. I think that is a function of the size, of the market. And then from a predictability perspective, now once you have that information, I would probably, again, give a higher marking to Ghana, because I think once you kind of have a sense for which way the wind is blowing, it tends to kind of stay in that direction, in Ghana, whereas here, we can, have some pretty sharp deviations.
All right. Mr. Maila, talk to us about your experience as well. I'm sure you have invested in other markets besides Nigeria as well, in terms of the ease of evaluating opportunities that are available in this market on the basis of the information that you are able to gather here.
Thanks. I think first and foremost is just a quick introduction with CDC. We are a development financial institution, 100% owned by the UK government. And secondly, where do we invest? We invest in Africa and South Asia. That said, Nigeria, in terms of our portfolio, is the largest in our portfolio. So coming to your question, we, in terms of from Cape to Cairo, we have got the view of what you call, trying to answer the question in terms of ease of doing business. I will say across the continent, it depends. It depends on one thing. There is one, what I call it, one political party called AGIP, a government in power. And that has got a major influence. You look at 2010, Tanzania was the hot place to be. And you look today in terms, you ask people, will you still put money in Tanzania? People, it's a question mark. And the same applies in South Africa. It all depends. So let me take Ghana. 3 years ago, 4 years ago, it was confusion what's happening in Ghana. The city was taking a knock. There was a lot of challenges that we're seeing. But today, it's a new wave. The same, if you ask me, almost 200 days ago about Ethiopia, it was under state of emergency. What Ethiopia has achieved in the last, since the new president, 100 days plus, in most of the African continent, I keep on telling you, it will take 50 head of states another decade or centuries to achieve what he has achieved in 100 days. So in comparison to Nigeria, where we are, the period in Nigeria, we're facing that elections are coming in within 12 months. That is the first port of call. Where is the capital? Typically tied in the pockets. We'll see what the elections, they will unfold. And if we use the previous experience of elections, we had elections. Immediately after elections, we had a standstill in Nigeria, whereby I think to appoint ministers and throughout, it took a little bit longer. That was another point, which what happened to investments took a little bit of an on hold, and the appointment of ministers. Thereafter, new policies came in. So I had the privilege, the first week of September, I was here with the group of investors arranged by Standard Bank. And all of them, when I was asking the same question, everyone was saying that we'll wait for the elections, we'll wait thereafter to see how things are going to go. The sentiment out there is that Nigeria GDP growing at sluggish 1 to 3%, it's way too low. It is unsustainable to be able to feed 200 million people at a growth of 2%. So on the flip side, people are saying it is a buy, but there is that caution. People are in support of the policies in terms of manufacturing, agriculture, the support. From when you read the policies that are being implemented and all that, from the headline, it makes us like, okay, let's roll the sleeves and do it. So there is a positive sentiment, but massive caution. Unfortunately, and I have to be quite frank, what happened in the last week of August with the MTN issue made people to put on hold. Because by June, July, I was speaking to several investors. They were really getting excited into Nigeria. So it all depends on the timing. If this few issues get resolved, you see the appetite. And when I was looking at the graphs from IMF, I was asking myself, each and every spike, what happened? And you'll find that if you dig deeper, either there was a headline that had an impact. So it's unfair for me to be able to say this one today is good, because every 3 to 6 months, I see these markets, massive changes in terms of that ease of doing business. And 80% is a sentiment of the holders of the capital, whether they'll put money to work. And when I'm talking about the holders of capital, it's not only foreign, including the locals.
And when it comes to making those decisions then to commit capital to an opportunity that you see, to what extent do influences that I would regard perhaps as being short-term, like the exchange rate, to what extent do they have a meaningful impact on whether you take the opportunity and how much capital you put in there?
So from our CDC, we've got 3 business models. The first one is what we call intermediate equity, where we go out and back what I call local fund managers in our markets. For example, we've backed Africa Capital Alliance, we've backed Sahel Capital that invested in ACE, Helios, Synergy, which are what I'll call the local people with the knowledge. So that's the first port of call. And this we make commitments of 10 to 12, 13 years in a fund. So it is not a view of today FX, it's not a view today of the headlines. These are commitments we make over long term. That's the first part. The second, the other 2 businesses is direct debt and direct equity, where we invest directly. Given we're an on-balance sheet investor, we can take a longer-term view. Azura Power Station here in Nigeria, again, we can take that long-term view. We can provide debt facilities, call it up to 10 years, even longer. The point in question, and I will recall very well when there was uncertainty with the FX a few years ago, whether is it 200, is it 300, is it 600? I was getting, in the morning is 200. Someone said, I changed somewhere, it was 550. That in terms of, because it has an impact when you're doing valuation of a business. Am I valuing a business at 200 in the morning? By lunchtime is valued at 400, or I'm going to value it at 600. That has an impact to say, because as an investor, you're going to say, hold on, let me wait until it's clear, I have visibility. So that, what it does is going to have timing in terms of making those investments.
So how do you then, I mean, this is a question for you as well, Ladelle, knowing the volatility that is out there, especially with respect to the currency, and the currency is a very important variable that you look at when you make these decisions. When you have to make this 5-year decision, or a 5-year commitment, a 15-year, 15-year commitment, there must be something else that underlines that decision, because it cannot be influenced by the volatility in sentiment today, the volatility in the currency today. If you are going to be making that commitment
for 5 years, you're going to be making that commitment for 15 years. What is it that you look for that tells you that I can commit $5 million to this business, 10 million to this business today for the next 15 years?
Sure. So when we're thinking about an investment, we're asking ourselves a couple of questions. First of all, does this business make money? Are we going to make money? Then the next question is, how much money are we going to make? And then, kind of the third, or what are the things that could come up that would inhibit our ability to make money? So we're really focused on one hand, we are trying to understand just the prospects for the business in the market. Now, the second thing is, we are fund managers. We don't really run the businesses. We want to assess the person that we're backing. And is this a person that we believe has the skills to manage a business, to grow a business, and also to kind of navigate, the market that we are operating in? And then I think the third is, coming to this point that we're, discussing, which is, okay, what is happening in the macro environment and how could that potentially impact, the business environment, and whether or not, what that could have in terms of impact on returns. So I'll give you a very good example. So we closed the investment in Biloxi Industries, which is a maker of cream crackers. I hope that you all eat Biloxi cream crackers, share them with your children, buy more, buy the big pack sizes. We did that on the 1st of August, 2016. Now, the work on that investment began in 2015 when we were looking at an exchange rate of 199. And then as the work continued and we were getting close to doing the deal, the exchange rates were, depending on which 3 or 4 you were kind of looking at, at the time. So now what was kind of the thesis? The thesis was, is this a good product? Do people like it? Yes, no. The answer to that question was yes. Do we believe and have confidence in the entrepreneur and the ability to, kind of deliver in the Nigerian context? Of course, the answer was yes, because he built a business to the size where it was of interest for us to be exploring it. Then the third was kind of what would be the macro, shocks that could come up, particularly around foreign exchange, because that obviously was a popular, that was, kind of the question of the moment. And so we had a number of conversations, which ultimately led us to the conclusion that there was not a far-off window whereby we would have some type of new FX policy being announced. And then it was a question of, okay, based on all of our conversations on work, could we try to handicap what that FX policy, would be? Could we look for opportunities to hedge around it, et cetera? So without kind of taking you through all of the analysis, what we ultimately came to the conclusion of was that there would be, a new FX policy. Based on where we thought that FX policy would land, we essentially kind of repriced the deal on what was a more market-driven 2016 exchange rate versus the exchange rate that we had in 2015. And we felt that, that was sufficient for us, kind of saying we're comfortable on the first 2 issues. Now, kind of what would be the impact of this foreign exchange. We felt like we had kind of handicapped that sufficiently. So much so to the point that we actually decided to put aside some of the hedging options that we were exploring, at the time. And by and large, those 3 things, kind of have all held true. But the one that we didn't, predict was that even though we would have an FX policy, that, we would have kind of some time period before that FX policy really kind of came into fruition. And as a result of that, and the kind of lack of confidence that was happening in both the international and the domestic market, seeing the multiple exchange rates, that we would essentially have a liquidity shortage. And so what really kind of impacted, the business was there were periods and times where, you know, our supplier of wrappers couldn't find FX to make the, you know, materials to provide us wrappers. So we have to shut down the factory for a couple of weeks. And so it was kind of that level of interruption that when I look back, you know, we didn't do enough work to kind of ascertain, you know, the breadth of the shocks that could happen if one of those, you know, theses, you know, fell apart. But to fast forward, what has ended up happening is we're back to now the first 2 points. Stability, you know, has more or less come in the market. Yes, you know, consumers are under pressure, but we have an entrepreneur that we're working that, you know, said, okay, this is kind of what's happening, so let's come up with a lower cost product in order to be able to, you know, serve the customer. And so kind of the first 2 planks, which really kind of drove the underwriting decision, is what's kind of helping us, you know, get back on track and grow the business. So a very kind of long example, but a real live one, because when that deal happened, you know, I got phone calls like, are you crazy doing this right now? Don't you want to wait until next year or wait until something happens? But you do your work and you know, make the best decisions that you can, of which those first 2 questions about are we going to make money, how much money are we going to make, and do we have a partner that we're aligned with that can help us deliver on this, you know, those are the ones that you really have to count on. Sorry for the long answer.
No, it was very good. I think it made the point fairly clearly. There is generally a perception in many parts of the world, or amongst many central banks, that foreign investors, especially portfolio investors, are a source of instability, either for the currency or for domestic macro developments as well. Having looked at many other countries, having looked at you know, macroeconomic analysis of many of these other countries, is that perception justified? I mean,
Thank you. Well, you have to look at it, why do you have foreign portfolio flows? I mean, of course, some of the foreign flows are coming in because of higher return, but why does a country need it? Because that's a way of mobilizing savings. That also creates space for domestic savings to go and land, and so that you borrow externally. That's one way of doing it. So, you know, it's not that foreign borrowing is bad, but it's good to have foreign borrowing that is coming in and that is stable. So yes, when you have hot money coming in, it can come in very quickly, it can go out very quickly. Yeah. And that is one of the source of instability. There's 2 ways to react to that. Reserves take a hit, or you let the exchange rate move. And comes back to my question earlier, what you want to do is try to balance that and attract the long-term flows. And how do you do that? By having the right macro fundamentals. And again, it comes back to the right policy package on both monetary, fiscal, and exchange rate, and structural reform.
I mean, listening to some of the comments, this is just my own observation, some of the comments and the way that you evaluate your opportunities, they're not particularly different from the way that a lot of portfolio investors will invest. Sometimes you will find investors who will decide that either because the currency has depreciated too much, or they believe that the currency has depreciated too much, and they make a decision to invest in a country, not because they want to make the 20% today and take the money out the following year, but typically they will make the assessment of the macro environment with a long-term view, taking into account some of those structural developments that you are talking about, Amin. Perhaps the last question from me, which is a general question for you two. If you were to advise the central bank, if you were to advise the other policymakers that provide information about their economies, like the Statistical Agency, the Central Bank, Finance Ministry, and other government ministries as well, what advice would you give them as to how they should approach the dissemination of information that is of use for investors who are interested in the long-term development and taking opportunities for the long-term development of their countries. Let me start with you, Peter.
I will say 3 issues. Number 1, stability, stability, and stability. For us as investors, and I can mention, we make projections, be it in business, be it in fund managers, in the economies that they are working on, or the sectors that they are looking at. It could be in power. To build a power plant, it takes long. The structures, the reforms of an IPP is a 20, 25 years. So lack of stability, what it does, it creates shocks into the system. It makes questions. So let me take a clear example that has happened in terms of the FX in the country 2 years ago. What did we see? So a local businessman had a loan of $10 million. The FX moves from 200 naira to 400. So effectively, the loan, he has now obligations to pay $20 million. You can see the heat in terms to that business. If that business has stability, we're not saying that the currency should remain at one level, but if it's going to have a shock overnight, that's what it does to a business, and business goes down. You mentioned in terms of the numbers that there has been negative growth in the non-oil, non-agricultural sector. I'm not surprised because I am aware in terms of businesses, they are still far, far way back, still trying to recover from the 2016 shocks. So that's exactly, and you ask that businessman, and he says, if I don't mind depreciating, Naira used to be at 100, it moved to 115, steady, and it does happen across the world. But the instability and the uncertainty to any businessman or any investor, that it's something they'll say, you know what, if I have that, I'll sleep better at night. That's, from my experience, the business that I've seen, the long-term projects in terms of funding, and throughout the fund managers we speak with. That is number 1 in terms of, if the CBN were to make a policy and stand on it to say it's going to be for another 5 years or 10 years, and people will know this is the policy, this is being followed with little shocks into the system.
It's interesting that you define stability not in terms of a fixed rate.
No, not in terms of a fixed rate, because fixed rate, unless you are the second biggest economy, you can afford it. Good luck.
Let me come to you with the same question. I mean, what advice would you give governments with respect, specifically with respect to the kind of information that would make your life easy when you evaluate these opportunities that have become available from time to time in the marketplace?
So I think because Peter hit the nail on the head, if you want to attract investment, stability is the magic word. And it doesn't have to be FX rate stability. So what I would say is that sometimes I find that with, the CBN, well, let me take a step back. So I think there was a Bloomberg survey that was done about 2 months ago about investing in Africa. And it asked kind of what were your biggest concerns. And the number 1 issue was basically monetary policy, CBN approach to governing the economy versus kind of all of the other things that people talk about, tax, corruption, those were much lower on the list. So this question is very important. And so where I think the CBN, and I would expand that to just kind of say broader leadership, is what is your kind of philosophy, right? Because if we kind of understand what your philosophy is, what are you focused on, then I think that kind of allows the question of stability to become an easier one to answer. So if it were information, if I were kind of a newly elected CBN governor, I would come out and say, okay, these are my priorities for Nigeria. And what underpins my priorities for Nigeria, or, well, we're talking about Nigeria today. What underpins my, priorities for Nigeria are, these kind of beliefs. And this is where I'm looking to drive this organization. And what I would hope is that that also would cause some narrowing of focus. So if the primary focus of monetary policy is going to be around managing inflation, then let it be about managing, inflation. Because when you mix other things into it, now I've got to kind of watch how you're playing in multiple areas, of the economy and ultimately my business, and it detracts away from this whole point of consistency and having, stability. So that would be kind of my advice on information I would add is have a governing philosophy approach and stick to it so that people kind of understand this is what we are playing for.
All right. Any closing comments? I'll give you a chance. Any one of you, closing comments from you?
From my side is that 2% growth is not enough. It's as good as asking someone to drive Ferrari at a 2 kilometer per hour. So Nigeria has the potential, has the population, is the largest economy in Africa. The wind is blowing behind you, Nigeria. I come back, all the issues being raised here, if well addressed in terms of stability, I'm long on Nigeria personally. You should be able to grow at least 8, 9, 10% is possible. That's from my point of view, because the foundation has been laid. Be it you look at in terms of the policies of the country, from power, all the issues that I do read the policies, they are boring documents. It's now the execution part. From agricultural sector, local manufacturing throughout. Those parts, and it's where in terms for us CDC, we're highly interested in investing. You say, talk about local manufacturing, agriculture and all those, we will fill up our boots. So it is the execution now. I think in terms of the government, what they've done, and people might not appreciate, is setting those policies.
All right, thank you very much. It's unfortunate that we only have very limited time. I'm sure there's quite a lot of other issues that we could have explored on this topic. Thank you very much. Round of applause, ladies and gentlemen, for the panel.
Thank you very much, Fumlele and the rest of your team. Please give them another round of applause, please. That's very heavy and in-depth from the panel. We're short of time, so we'll not be able to take questions and answers. We need to wrap it up. Anyone wants to join the photo ops? Maybe I should. Thank you. Thank you very much, Ladell. Thank you very much, Robbins, and the rest of the team. Let's just move on quickly and bring this FMDA Markets Conference to a close. Let's take our closing remarks from Adeton Dosumu, the Vice President at FMDA. Adeton, where are you? Okay, here we go.
So much for coming, and I must apologize once again for us starting late. Anytime I come to these conferences, I do quite a lot. We attend quite a lot of it. But at the end of the day, what are we going to do with what we have heard and what we have learned and the questions that have been answered? That have been asked. The truth of the matter is that this market can only be developed by us. We can wait for foreign investors to develop the market. It's our market, and we have to find a way to develop it by ourselves. Yes, there are many constraints, yes, there are many problems, but we have to find a way within this market to grow it and to move it forward. And that's the challenge for each and every one of us here today. And you know, everybody talks about change, but then the change begins with each and every one of us in our own way, at your jobs, as you go about your daily business, in the things that you do. There's so many issues, but let the change begin with us, one day at a time. Thank you so much, and God bless you for coming.
Vice President at FMDA. Ladies and gentlemen, we thank you all for coming. On behalf of Financial Market Dealers Association, let's formally bring this event to a close. Let's all rise and take the anthem of the Federal Republic of Nigeria. Two quick announcements, ladies and gentlemen. The first one, we have cocktail courtesy of FMDA and the sponsors. Then the second one. How many of us watched Skyfall? The movie Skyfall. If you watch it, okay, check your social media and you hear the news outside. Have a good evening.